In this episode, I'm going to alert you if you or somebody you know has a premium financed IUL, and why I'm going to encourage you to get that policy audited, because we've had some horror stories lately where we've come across some IUL that was not structured correctly. And when the client had their policy audited, oh my heavens, it was a huge wake-up call. And we were able to fix it. But many of these clients kicked themselves because they wish they would have had it audited sooner than later. And so get ready. I'm going to give you a few insights on what to look for and why this is so critical. So again, I'm Doug Andrew. I've been a financial strategist and retirement planning specialist for north of 5 decades, helping thousands of Americans optimize their assets and minimize taxes. Well, my favorite financial vehicle, without question, is a properly structured, max-funded index universal life. Most clients have come to me to use it for living benefits, to accumulate money tax-free, and also to be able to access that money income tax-free and generate tax-free income. But also, there's another benefit, the death benefit, that comes along for the ride, so to speak. And the way I like to structure IUL is so that the death benefit, which is required by the IRS, so that your money accumulates tax-free and you can take tax-free income out, which knocks the socks off of IRAs and 401ks, the death benefit is actually paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax if many people followed the herd, which they do, putting money in tax-deferred IRAs or 401ks in the market, where they would have to earn 12% returns in a 33% bracket to net 8% after tax, or in a 25% bracket, 9% after tax. But after taxes and fees, they earn 12 and only net 8, because usually $1 million nest egg earning 12%, theoretically you could pull out $120,000 a year, but you're going to have to pay, $30,000, $40,000 in tax and another $10,000 in fees on that $1 million nest egg. So it's unfortunately, people have to earn 12 to net 7 or 8, or they have to earn 15 to net what I've been netting on my IUL, which is 10, okay? I only have to earn 11 in an IUL to net 10. That 1% is not tax, it is the cost of insurance that the IRS says has to be there in order for it to be tax-free. Now, because of this, there are a lot of agents out there, whether it's for death benefit or the tax-free accumulation of money for living benefits, both, one or the other or both, they show clients how they can premium finance it. In other words, they have insurance capacity. And capacity is based upon a function of your income or your net worth. And a lot of times people want a life insurance policy, whether it's for the tax-free proceeds at death to provide for a charity, for their family, for their own estate, their family office, whatever it is, high net worth individuals. So they want to create an immediate tax-free estate when death occurs, but also they want to use it for tax-free accumulation. And so they understand max-funded IUL is the dream solution. Well, a lot of times business owners and people, they say, well, I don't want to put all my own money in this right now. And so there are lenders, okay, that will loan the money to pay the premiums into an IUL. And so it creates an arbitrage. If you don't know what arbitrage is, this is where lenders will finance the premiums on a life insurance policy. In this case, we're talking about IUL. And so you're taking out a loan and they charge a certain interest rate on the loan. Now, if the interest rate is, 3, 4, 5, 6%, that's doable. Now, the interest usually accrues. And so I'm going to simplify this. Sometimes I've had people that wanted to donate to a senior citizen center or to a hospital or the Boy Scouts of America or whatever, and they had insurance capacity. The IRS said they were worth, $5 million, but they didn't have the cash to donate that, but they could donate life insurance. They could donate their life to be insured. And so, we would find some premium financing company, a lender that would loan the money for the premiums. And so the premiums for a $5 million policy end up being several $1,000s a month, or it could be $50,000 a year, whatever. But that money is lended to pay the premiums, and it accrues with interest. So that if you die 5, 10 years later, 15 years later, you have this outstanding loan balance with interest. Even if that loan balance has grown to $2 million, when you die, you have a $5 million death benefit. There is a lien on that death benefit, okay, as a collateral assignment that pays off the lender with interest. And so that's $2 million, but you have a net of $3 million left over tax-free that goes to the charity or the family or the senior citizen center or the Boy Scouts or the church or whatever, whoever you left it to. So in other words, you get life insurance without you shelling out your own money. You're financing the premium at a lower interest rate that, with the accumulation of that interest, that deducted from the death benefit, still leaves behind a net death benefit that is very substantial, and you don't have to tie up any cash flow. Does that make sense? That's a simple example of a premium financed IUL. Well, what happens is there's a lot of insurance agents out there that call themselves fiduciaries. Now, a fiduciary is supposed to be looking out for your best interest. And the problem is we come across these all the time when people watch my YouTube videos. And we actually had this happen here just recently, where a gentleman watched some of my YouTube videos and he goes, "Oh my heavens, I understand this IUL really well. I understand it so well from Doug Andrews' videos that I don't think my IUL is structured to optimally perform like he's talking about in his videos." He could tell. So many of our clients watch videos or read my book, The Laser Fund, and they end up knowing as much or more than most agents do. So that's what happened in this case. He looked at his IUL policy, which was premium financed. And he's got this accruing loan with interest, and he's looking at it and he's going, "This is accruing some pretty good interest here. But golly, I think there's more death benefit than what I needed to have, or this was not structured to be able to earn, 10 and net 9, or structured to earn 8 and net 7. The loan is accruing at 5 or 6%. Mr. Andrews says you could diversify and rebalance and maybe earn 11 and net 10. And it looks like I'm going to be lucky to earn 8 but only net 4 or 5. Okay. Now, if you don't understand this is why you need to read my book. But he could see that his policy was not designed the way that I talk about on this channel. And so he came to us, he reached out and wanted his policy audited. Sure enough, this fiduciary had structured this IUL with premium financing. I hate to say this, but it looks like he structured it more for his wife and kids, the commission, than to perform optimally for the client. And so when we showed him, well, this is how a properly structured IUL can work. If you do it this way, you will have a better rate of return, but your net internal rate of return, the cost of insurance, at the end of the day, will only be using maybe about 1% of your gross rate of return. Your gross rate of return can be higher. And if you earn 9, you'll net 8. If you earn 8, you'll net 7. If you earn 11, you'll net 10. Right now, you're lucky to earn 8 and only net 4. And he could see that. And so one of our agents who we have trained was able to correct and fix that and replace that policy and have it set up correctly. So the message in this episode is, if you or somebody you know, okay, your parent, somebody you know, a business partner, has a premium financed IUL, I don't care if it's a premium financed whole life policy, you ought to get that policy audited to see if it's structured to perform optimally for what you're doing it for. And unfortunately, I think there's thousands of policies out there that are not structured near well enough to perform as they could so that it will maximize not only your rate of return, but maximize what you leave behind at the end of the day if you're using it for death benefit. You could be earning a much better rate of return and end up having the money grow faster to cover the loan so that the net amount left over if you die is an extra $500,000 or $1 million or $2 million. You're missing out if it's not structured correctly, okay? So if you want to have it audited, reach out to Laser Financial. Go to laserfinancial.com. You can even claim a free copy of my book, and I'll show you how you can reach out to us and just say, hey, could you audit my policy? I've got a premium financed IUL. I want to see if it's structured to perform optimally or if I'm wasting money or I'm going to miss out on hundreds of thousands of dollars because it's not structured right. So if you go to the link below, Laser Fund, you'll have the opportunity to claim a free copy of my book. You can buy it on Amazon for $20 up to $60. And if you do that, thank you, but I'll gift you a copy for free. Simply go to laserfund.com and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that and I'll pay for the book and I'll fire out a hard copy to you via priority mail. It's actually 2 books in one. This side is all the charts and graphs and explanations. If you're more of a right brain learner, you flip it over to the right brain side. This is the left brain side. And these are the stories and examples, 62 of them. You'll learn about this. But while you're in there claiming your free copy, you can schedule an appointment with an IUL professional who understands. There's a very small handful in America of IUL professionals that have been certified. We have trained them, we oversee them, and they know how they should be structured correctly. They are all trained on how to audit IUL policies to see if they're structured right, whether you're premium financing them or not, okay? So if you want your policy audited and you're suspicious that it's not performing as well as you thought it could, if you're not earning average returns in the 7, 8, 9, 10% range, and at the end of the day, here's the telltale sign. If your costs of that insurance aren't being totally covered by the interest on your cash value, by the 5th year, you better get it audited. If your cash value will not grow in the illustration to equal or exceed the death benefit within the first 10 or 15 years, you better get your policy audited. It wasn't structured well enough. Your policy, the cost should be covered within 5 years by the interest you're earning. The cash value should grow to equal and exceed the death benefit as early as 10, 11, 12 years in the policy. Your internal rate of return. If you go out 20 years into the policy or longer, and if your average return was 8, you ought to be netting 7. If your average return was 11, cash on cash, your internal rate of return ought to be 10. If you don't know how to calculate internal rate of return, what is called IRR, reach out to us. We will audit the policy and calculate the IRR for you, and we'll show you how you can dramatically increase that so that you're not missing out. So this is not about us. This is about you and your bigger future. Let us audit your policy and see if it's structured right. If it isn't, we'll show you how you can fix it, and we'll let you know if you can't fix it and why you ought to replace it and how to do that the smartest way.